And you guys, if you are interested in looking into the Real Estate Investing Masters Mentorship Program, you can go to reimasters.ca. It has all the information on the website, or just shoot Wayne or I a message, and we'll, get an explanation over to you and give you some more information, and let you know if it's right for you.
Okay. Anyways, let's get into the BRRRR strategy. Well, first and foremost, it's probably best to explain what the BRRRR strategy is. It's a B with 4 R's. And what it stands for is buy, rehab, or
Renovate.
rent, refinance, repeat. Okay. The term BRRRR was coined by one of the guys over at Bigger Pockets years ago. Maybe Brandon Turner. Everybody says it's Brandon Turner, but I don't think it was him. But the BRRRR strategy, the strategy of buying a property, renovating it, turning it into a rental, refinancing with the bank, and repeating the process is decades old. It's just Bigger Pockets just finally added a name for it and created a book. Now, let's I guess we can break down what all of this actually means. So when you buy, what you're doing is you're purchasing a property, often below market value, with the intention of improving its value through renovations or repairs.
Pretty simple.
Pretty simple, right? It is a little more complicated than that. I would say, arguably, that the B is the most important letter in that whole strategy.
Yeah, it's debatable, but yeah.
I'll debate you all night.
I think
Because if you
I
don't
think a
buy,
lot of people fail because of their renovations.
true dat.
So,
But if you buy the wrong property, you're screwed regardless.
From the start, that's true.
Right?
Yeah.
You have to buy the right property, and you have to know how to identify an opportunity. Because just because you bought a property for under market value does not mean that it's going to work and that you're going to be able to refinance and get all or most of your money out. The second one is rehab or renovate. So after you've acquired the property, what you'll do is renovate or rehabilitate it to increase its market value. This may involve cosmetic upgrades, structural repairs, or both, depending on the property's condition and investment goals. So you want to find, like I said, an opportunity that you can renovate it and increase the value beyond the price or the cost of the renovations. So you want to say you buy it for $200,000. You want to renovate it for $30,000. You want it to be worth more than $230,000. Okay. It needs to be able to increase the value of the property more. And you can't just say that I added a basement, so therefore my house is worth $100,000 more. There's a little bit more to that. And you got to make sure that you have a good investor focused realtor who's going to be able to help you with identifying what the value that's going to be after the renovations. Once it's done, this strategy is a rental strategy, by the way. So once you've completed the renovations, you are not selling the property like a flip. You are selling it to yourself. So it's going to be, you're going to renovate it. You're going to renovate it for a rental. And once the renovations are done, you're going to put a tenant in it and rent it out. Okay. The next step is to refinance. And what that means is you're going to go to the bank and you're going to say, hi, I'd like to refinance this property. I'd like to get a new mortgage for this property based on its current value. They don't care about what you bought it for. They don't care about what you did to it. All they care about is what is the value today, and we will give you up to 80% of the value of that appraisal in a new mortgage. Okay. So if you bought it for 300, sorry, what did I say? 200? If you bought it for $200,000, you did $30,000 worth of renovations, and now the property is worth $300,000. If they go and they hire an appraiser and the appraiser says, yes, this house is worth $300,000, the bank will say, okay, cool, Gabby, I will give you a mortgage of up to 80% of $300,000. Can anyone tell me, just really quickly in the chat, what is 80% of $300,000?
May I?
Sure.
240.
Sure. Well, the answer's
Okay,
just
there you
coming
go.
in right now. Yeah. It's $240,000.
I didn't know if anybody was actually doing the math and we were just going to sit here and wait.
Yeah. I got time to kill. It's $240,000. So you bought it for $200,000. You put $30,000 worth of renovations into it, and now it's worth $300,000. Bank says, okay, cool. We're going to hire an appraiser and see what the appraiser says the value of it is. Again, they don't give a shit what you bought it for. They don't give a shit what you did to it. That's not the point. The point is, what is the house worth? And this is why I said earlier, when you buy it, it's incredibly important that you're working very closely with your investor focused realtor, because you need to know, you need a crystal ball. You need your realtor to pull out the crystal ball and tell you, if I do this work to this property, what will the value of the property be? And they go, voila. If you do these renovations, the house will be worth $300,000. Then you know it's a good deal. But if you've got a cheap realtor who doesn't know how to do this stuff and doesn't work with investors, and they pull out their magic 8 ball and they shake it up and say, will the house be worth $300,000? And then they shake
It
it
is
and it says,
likely.
or it says, maybe so. Is that valuable enough? Is that good enough information for you? Maybe so, on a magic 8 ball for you to move forward with this? What if the value is $220,000 and you're into this property for $230,000? You probably wouldn't want to do that deal. One, you're not going to be able to refinance and get all your money out. Two, you're going to be negative $10,000 on this deal, right? So you got to make sure you have an investor focused realtor who can do that analysis for you to determine the after repaired value before you buy the property, so that you know exactly what renovations you need to do, which will increase the value to where you need it to be. Again, we're going to go to the bank. Renovations are done. Hello, TD. Hello, RBC. I'd like to refinance my property. And they say, okay, cool. We'll get an appraiser out. The bank hires an appraiser. You pay for it. They hire the appraiser. Appraiser goes out and says, this house is worth $300,000. RBC says, okay, Gabby, we will give you a mortgage of we can give you up to 80% of that value. So we can give you a mortgage of up to $240,000. Gabby, you don't have to take the whole $240,000. However, that is how much we will give you. How much do you want, Gabby?
240, please.
Yeah, of course you want every penny, don't you? Of course you do. So what happens is the bank says, okay, not a problem. First things first, we need to pay off your old mortgage. So if you bought the house for $200,000, you probably have an old mortgage of $160,000. So they're going to take that old mortgage. So they're going to take the new mortgage, sorry. They're going to send the $240,000 to your lawyer. Your lawyer is going to take that $240,000 and they're going to pay off your $160,000 mortgage that you have on title. Cleared. Now there's only going to be one mortgage on the title, which is your new $240,000 mortgage. But remember, they gave you $240 and you paid off your old mortgage of $160. So there's going to be an $80,000 left over that's in your lawyer's hands. Your lawyer is going to hand that $80,000 to you in the form of a check. Now you have $80,000 in your hand. You're going to pay off your original down payment, which was $40,000. Gone. You have $40,000 left, but you spent $30,000 on renovations. You put it on a credit card. You're going to take 30 of the 40. You're going to put it on that credit card. Gone. So now you've paid off your down payment. You've paid off your renovation funds. You've paid off the old mortgage. You have a new mortgage for $240,000, and you have an additional $10,000 in your hand on top of that. So you got all of your original money back, your renovation money, your down payment money, and plus $10,000 extra. Sounds like a pretty decent deal, eh?
Sounds very decent. I'll take that.
And you still own the property.
Yeah.
You still own the property, which there's a tenant in it paying off the mortgage and paying all your expenses. There's one more really cool thing about that. Remember, you have a new mortgage for $240,000. How much is the property worth?
300.
How much?
300.
300. You have a house that is worth $300,000 and a mortgage on it that's $240,000. I see Nathan in the comments there. He says equity. You made $60,000 worth of equity as well. If you were to sell that property today, not including realtor fees and other closing costs, you would have a $60,000 check that you made through the renovation of that property by increasing its value. It's pretty cool.
Very cool.
In this example, you made $60,000 in equity, plus you had $10,000 in your pocket. You made $70,000 on this deal, and you have none of your own money left in it. That's why the BRRRR strategy is so incredibly cool. But wait, there's more. Now that you have all of your money back out, all of your original down payment money, all of your renovation money has been paid back on the credit card, could you do it again?
Repeat, baby.
That's the last R in the whole thing, in the BRRRR strategy, is repeat. Now that you got all your money back, go find another $200,000 property, run it by your realtor, and try and repeat the process over again. In theory, you should be able to repeat this an infinite amount of times. In theory. It's a pretty cool strategy. In theory. And Gabby and I have utilized this strategy ourselves many times. Early on in our investing journey, we utilized this many times. And not every deal is all you're with. Why do I stutter at the 50-minute mark?
Reset.
My mouth was dry. I'm just going to take a sip of coffee. Not every deal means that you're going to get all of your money back out, though. And the example that we gave originally is what's called a quote unquote perfect BRRRR. Meaning a perfect BRRRR is when you get all of your initial investment back out, all of your down payment, all of your renovation funds. You have no money left in the deal. That's called a perfect BRRRR. An imperfect BRRRR would be if you got some or almost all of your money back out. I'll give you a different example. Actually, I don't want to give numbers because I feel like I'm going to put people to sleep. But in that previous example where there was a $240,000 mortgage, we were able to get all of our money back out, plus we got some back in our pocket. What if we only got half of our money back out? What if we only got, we had $70,000 in the deal, right? $40,000 down payment plus $30,000 renovation. Mm-hmm. What if we only got $35,000 back? Or we got all of it, but half of our down payment money? That's a better example. What if we got $50,000 of our $70,000 back? Well, we got all of our renovation money back out, which is bonus, right? Mm-hmm. And we got half of our down payment money back out. So instead of buying a $300,000 property and putting 20% down, we have a $300,000 property and we only have $20,000 down payment.
Yeah, 10% down.
Less.
Well, yeah.
Yeah. I know it's not a perfect BRRRR, but what you've done is you have multiplied your ROI significantly. Significantly. I wish I had like a real, like I had a whiteboard where I can show the numbers. It'd just be a little bit easier for figures. But by reducing your down payment by half, what you've done is you've doubled your ROI. Because now that this property is a rental property, you're still going to get the same revenue on this property. You're still going to get the same amount of rent coming in every year. It's still going to be $2,000 a month in rent, which is $24,000 a year in revenue. Right? And you're going to have to pay your expenses and everything else. And let's say your total net profit for that property is $15,000 or $10,000. Your total net profit for the year for that property is $10,000. Would you rather have a $40,000 down payment to make 10,000, or would you rather have a $20,000 down payment to make 10,000? I can leave it for the chat if you guys, but I think it's a pretty obvious answer,
Yeah.
right?
Yeah.
You would much rather have a lower investment to make the same amount of money. I would rather invest $20,000 into a property to make $10,000 a year than $40,000 to make $10,000 a year. I just doubled my ROI,
Mm-hmm.
right? So yes, you're not, in most cases with BRRRRs, you're not going to get all of your money back out. But what you are doing is you are increasing the return on your investment for your portfolio. And if you repeated this process continuously and built a portfolio like this, your portfolio would be making significantly better returns on your investment than they would if you just bought them all retail for full price and didn't do any creative strategies. So the BRRRR strategy is not only a strategy to help you recycle your funds and get all of your money back out and do perfect BRRRRs, it's also a strategy to help you increase the return on your investment on your portfolio. And it doesn't always have to mean that you have to get all your money out. I'm saying all of this because so many people chase the perfect BRRRRs
Mm-hmm.
and they never find them. They're like, oh, this strategy doesn't work.
If I can't get all my money back, I'm not doing it. I'd rather put 20% down on something.
Yeah. Which is just, it's, you're not looking at it from the right angle. And don't forget the equity build, the equity that you build into it as well is profit. It's not just the fact that you've reduced your down payment. You've also increased the value of the property significantly more and built equity. Keep in mind that you may have $20,000 left in the deal, but you've probably got $60,000 to $70,000 worth of new equity as well. If you add that in, and this is very hard to do on an audio podcast, if you add that in as well, the equity that you built in from doing that renovation and refinancing it, your ROI goes through the fucking roof. You have $20,000 left in the deal and you made $70,000 worth of equity or $60,000 worth of equity. Do the math. Your ROI is through the roof, significantly higher than buying just normally with a 20% down payment. Significantly. So yeah, I absolutely love the BRRRR strategy. I think it's fantastic. Anytime you can buy a property a little under market value and you can do some strategic renovations to increase the value and then get some of your down payment back, but also it will increase your return on your investments exponentially.
Yeah.
Highly, highly, highly recommend it. Okay. I had some other things here, some extra notes, but I mean, I feel like we really hit the nail on the head today. Was there any questions that came in or any comments before we wrap up today's show?
There was. There was a couple questions about the mortgage products themselves. So, what kind of mortgage product would you use for the initial buy and rehab before the refinance?
Who asked the question?
Paul.
Paul. Okay. I don't see it. How far back? Oh, okay, I see it now. What you'd want to do is you want to make sure that if your plan is to buy it and do the renovations and refinance it right away, you're going to want to make sure you use a mortgage product that complements that. I would not lock into a 5-year fixed mortgage. That would be silly. Because when you lock into a fixed mortgage and you cancel that mortgage to refinance to another mortgage, you're going to pay some hefty penalties. So make sure that the mortgage product that you choose has minimal amount of penalties. Additionally, what you can do is you can use a private mortgage, which would be a higher interest rate, but less penalties and better and more clear expectations between you and your lender. There are mortgage products out there that have higher interest rates because they know that you're going to be using it for short-term financing. Mm-hmm. And sometimes they're just, you're going to pay a little bit more, but they're easier. It's the right thing to do because the lender knows what to expect. If you're doing, say, a variable rate mortgage because with TD, because it's only 3 months interest for your penalty. In most cases, you're probably on somewhere in that mortgage contract, you're telling them that this is going to be a rental property, and yet you're going to renovate it and then refinance and cancel that mortgage within a few months. And you're basically lying to the bank, because the bank thinks you're going to put a tenant in on day one. They don't know that you're going to renovate it and then cancel the mortgage in 4 months. So make sure you're choosing the right mortgage product from an honor standpoint, but also making sure that you're reducing your holding costs and your penalties.
Yeah.
I talked to a mortgage broker. That would be my best recommendation.
100%.
But I think private mortgages are normally, if your plan is to refinance right away, private mortgage. Okay. Rain had a question, I think.
In the refinance, is it the same bank who gives the mortgage to refinance?
Sometimes, but not
Not all the
necessarily.
time. Yeah.
I'd argue that it might be a little complicated when you buy a property for $200,000 and then 6 months later you call the bank and be like, hey, I'd like to refinance at the new appraised value. And they say, okay, cool. What happened? Didn't you just buy it for 200? And you're like, oh yeah, I did some strategic renovations and now it's worth 300. They'd be like, oh, okay, cool. So now you want us to give you a mortgage for 80% of the new value? And you'll be like, yeah. And if you were lending someone money and you wanted them to have some skin in the game, and they just like straight up admitted that they don't have any more skin in the game and that they're going to get all their money out, would you allow that refinance? Probably not. And this is why this strategy, again, I said in theory multiple times, because banks have been cracking down on this for the last few years, and they've been adding different rules trying to prevent it, because so many people have taken advantage of rising markets in years previous, where the values just keep going up and up and up and up, and then people they don't even do any strategic renovations. They just go and refinance at the new value as the values go up, and then they get all their money back out. And what's happening is people are getting over leveraged and they don't have any of their own money left in the deal, and they're all negative cash flowing properties. And it's not sustainable. So, but anyways, I say that because banks are not going to be happy that you want to refinance with them, get a new mortgage, because you increase the value, knowing that you don't have that much skin in the game. So generally speaking, like, it's normally a private mortgage. You go to a private lender, or and then you would refinance to a monoline or an A lender for those nice low interest rates, because you're going to, afterwards when you refinance, you want to make sure it's a nice low interest rate, because you're going to be renting this property long term now in your portfolio.
Okay. Can you answer 2 more questions really fast?
Probably not, but I'll try.
Okay. Would you prefer doing this in big town versus a small rural area to optimize appreciation?
100%.
Yeah.
I'll tell you a million reasons why big town over small rural. Because small rural, this is why we see so many people who fucked up over the last few years. It's because they were doing, oh, look at us, we'll teach you how to do perfect BRRRRs. And they're doing it in small little towns. But long term, it wasn't sustainable, because those small little towns didn't meet the basic fundamentals of real estate investing. So they were looking at it from one dimension of like, let's get all my money back out.
You could do a perfect BRRRR.
You can do a perfect BRRRR, but then it doesn't work long term, because you're in a shitty market that doesn't have very good cash flow.
Yeah.
So yeah, big town is significantly easier, and I'll tell you one other reason, because when you're doing when your bank is hiring the appraiser afterwards to do an appraisal, what they're doing is they're looking at, I don't have time to teach appraisals, but they're looking for other properties that have sold in the area on MLS that are similar to yours within the last 3 to 6 months. In a small town, you don't have those sold comparables. In a big town, you've got lots. And in a big town, what you want to do is you want to wait strategically for someone else who sold a property similar to yours at a certain price, and then go and do your appraisal. Because you can, you can get your realtor set you up on a search and be like, okay, let me know when another property like mine sells in my neighborhood. It'll notify you in your email, and you can see, okay, cool, this property just sold for $320,000. Perfect. Call up the bank, say, hi, I'd like to refinance my property. because you know that appraiser's going to pull the same comps that your realtor did, and they're going to see that $320,000 sale, and your appraiser's going to be like, okay, cool, your house is worth 320. You're like, score. But if somebody sells a house around the corner for $250,000, then you don't want to do your appraisal at that time because the appraiser's going to say your house is worth 250. Make sense? It's a little bit harder to do all that and be strategic like that when you're in a small rural area. Cool. That's my fast way of saying.
That was a little longer than I expected.
That was fast.
It was valuable. And are we still getting 80% loan to value on refinances right now, or has that changed?
It's changing.
And depends on the product, the mortgage provider.
I have to, let's get Keaton on just to verify that. If I understand correctly, HELOCs have changed up to 65%, but I think you can still do refinances up to 80%. I think they just changed home equity line of credits to max at 65. If my memory serves me correctly. Make sense? Okay. But anyways, guys, we have a fantastic, again, I'm pitching like crazy today, but like we have a fantastic BRRRR workshop in our Real Estate Investing Masters mentorship program. And if you guys are on the fence about it, like we literally have everything that you need as far as workshops, resources, checklists, cheat sheets, plus us as coaches. And if these are things that you're interested in and you want to utilize and leverage these strategies and build and scale your portfolio faster, I highly recommend just checking out the mentorship program. Honestly, it's the bee's knees.
Wayne, I also want to just pump your, and I just pumped your own tires, but I'm going to pump your tires a little bit more because that was pretty impressive. And I'm sure that you guys who are here live, or if you're listening later, can agree with me that you just basically gave a BRRRR crash course in 30 minutes. 30 minutes. Yeah. With really good information. So kudos to you. I don't know many people who could just spit it off like that. You're definitely unique.
Oh.
In the best way possible.
Gosh. You're a huge flirt.
Okay, you guys have a fantastic Monday. We'll see you tomorrow. Tomorrow's Tuesday. We'll be here. We'll see you then.
We'll be
we'll be here.
We'll be here. Bye, guys.